Hello everyone and welcome back to xm.com. It's Tuesday, June 6th, and this is a weekly technical analysis video analyzing the three most interesting charts that might attract attention later this week. So starting first with dollar loonie, we have the Bank of Canada's rate announcement on Wednesday, and investors provide a 60% probability for interest rates to remain steady, but there are expectations for another rate hike later this year. And if that proves to be the case, if the central bank uses a hawkish communication, that could extend the loonies recovery, latest recovery against the US dollar, especially if the Canadian employment data come out stronger than expected this Friday as well. So that could keep the focus on the 1.3340 region, where this almost flat support trend line is located, as well as the 50% Fibonacci retracement of this downtrend over here. Any decline below that region could extend the sell-off towards the 1.3225 key zone, neutralizing the big picture. Now, if the technical indicators down here are still sloping downwards, but the stochastic oscillator is already below its 20 oversold level, so that suggests that this decline over here may not last for longer. So if the price manages to stay above 1.34 and pick up steam above 1.3440 as well, we might see a test near the simple moving averages, where a bearish cross between the 50 and 200-day moving average is taking place at the moment. That would be, if completed, that would be the first bearish cross between these two lines after almost 3 years. So moving higher from here, we can see another challenge around 1.3650. That was a key resistance territory during the previous 2 months. Thought what would be more important for this market is a key rally above this long-term resistance trend line coming from the 2020 peak of 1.4667. That is also where the 61.8% Fibonacci retracement of 1.38 is located. So any increases above that region could boost optimism for bullish outlook. And staying in central bank news, the Reserve Bank of Australia has just announced a surprise 25 basis point rate hike, despite expectations for no changes. And we expect GDP growth data to come out during Wednesday's Asian session. So if the data support additional rate hikes, as the central bank signal that that may happen, that could extend the AUDUSD recovery, and we would keep a close eye on the 0.6720 region. In this case, this is where this tentative resistance trend line is located, break of which could drive us straight up to the 0.68 resistance territory. This is where the 38.2% Fibonacci of this up leg over here is located. So another significant close from above that level could confirm additional gains, likely up to the 23.6% Fibonacci of 4.6923, taking the price out of this range over here. We actually don't have strong bullish signals yet. We see the indicators down here sloping upwards, but the RSI has yet to climb above its 50 neutral mark, and the stochastic oscillator is already near its 80 overbought level. So we might see, so some caution may stay in this market, and if the price fails to overcome the 0.6663 level, which is the 50% Fibonacci, we might return down to test the 0.6525 and 0.6565 base. And if the sell-off extends below the 61.8% Fibonacci of 4.6483 as well, then that could upset traders, likely triggering a new bearish action towards the important 0.6360 zone. This is where these this is where the support trend lines coming from the 2020 low and the 2021 lows are located. And finally, switching to WTI oil futures. Well, we had a surprise production cut from Saudi Arabia. Saudi Arabia decided to cut production by an extra 1 million barrels per day, while other OPEC members have extended their previous production cuts. Well, that boosted WTI oil futures up to the 50-day moving average near 74.85, but gains proved short-lived, with the price reversing lower and below the 20-day moving average, currently trading near 70.50. We don't have bullish signals here. Again, the RSI is marginally below its 50 neutral mark. The MACD is close to its red signal line, and the stochastic seems to be losing momentum already after a rebound during the previous days. If that decline extends, we might see another test near the 68.35 region, where the price bounced almost twice since the start of, during May. So a decisive close below that floor could drive us back to the 64 floor, where the price has formed a double bottom. So another failure here could trigger a new sell-off, likely down to the lower boundary of this bearish channel at 56, unless the 61.77 barrier from 2021 manages to add a strong footing under the price. Now, alternatively, if we see another rebound near 68.35 and a close back above the 20-day moving average, then the price will attempt to overcome this resistance line and the 50-day moving average, which are both within the 74.85 and 76.25 region. A break higher could face another obstacle near the 200-day moving average, as it did back in March. That's around 79.27. While higher than that, the 83 region may attract special attention, since the 38.2% Fibonacci of the 2020 and 2022 uptrend, as well as the is located here, and we have seen that this region has been acting as a key barrier for a couple of months now. So that's the end of this weekly technical analysis video. Thank you for watching, and see you next time.